Comment. Welcome to the viewers of the comment channel.
Bankruptcy epidemic 2023, the world still has epidemic problems. Beginning with the corona epidemic, then the epidemic of wars, then the year 2023 came as a disappointment. The year 2023 has been marked by bankruptcy. How to get your money back after the bankruptcy epidemic? Banks are the safest place to keep your money, but what if the bank goes bankrupt? To protect yourself and avoid panic if your bank defaults, it is important to understand the situation and what you can do about it. The main thing to remember is that as long as your money is insured by the central bank or the responsible institution in the country you are in, and it probably is, a large part of your money is safe. But you must know first, what causes bankruptcy? Banks go bankrupt when they are no longer able to meet their obligations. It may lose a lot of its investments, or become unable to provide cash when depositors demand it. Regulatory issues. When authorities boycott foreign banks, it puts them out of business in the U.S., because the banks are involved in illegal activities such as money laundering or operate in a sanctioned country. Proprietary trading. Companies and businesses owned by banks often make large profits, but financial sector regulators believe that there is a high probability of large losses, especially in the case of high-risk investments such as ownership of securities. Non-banking activities. Over the years and in order to enhance profits, banks have engaged in unconventional activities such as real estate investment funds and consumer finance companies that were not entirely successful and resulted in huge losses. For these reasons, large banks must have strict and periodic procedures for the risks surrounding the bank's portfolio, and these procedures consider all perceived risks, including the risk of interest rate, foreign debt, investment, and others. When there are miscalculations in measuring these risks with a large market movement, large losses are possible. Also, the existence of disproportionate loans to bank employees is a danger. This happened in the 80s of the last century, when many banks around the world lent money to their managers and employees in order to buy real estate or finance ill-conceived projects, which eventually led to large losses. Employee abuse. Some employees exceed the applicable regulations, exposing banking institutions to large losses or causing damage to the bank's financial position. Insurance does not cover. Insurance covers the money of depositors in the United States up to a certain amount of money, but in other regions of the world the risk exists, and if they demand all their money, the bank is likely to collapse. After all, bankruptcies happen because banks don't just keep your money in vaults. When you enter and deposit money, or deposit money electronically, the bank invests that money. A simple form of investment is to make loans to customers of other banks so that they can earn interest and pay the rest in the form of interest/dividends on your deposits. Banks also invest in more sophisticated ways. If the bank incurs significant losses in any area, it risks bankruptcy. What happens in the event of bankruptcy? Most of the commercial banks in various countries of the world are insured by a government institution affiliated with the central bank, and if the bank you deal with is one of these banks, you can count on the central bank to make sure that you get part of your money in the event of bankruptcy. The first option is to transfer the insured assets of the bankrupt bank to another strong bank. In some cases, this option is not available, and the central bank or its affiliate will ensure that you receive the insured portion of your deposits. In America, for example, the Federal Deposit Insurance Corporation insures up to $250,000, and in Turkey, the Savings Deposit Insurance Fund insures an amount of 150,000 lira or its equivalent in hard currencies. So holding more than that in any bank may put your money at risk. Uninsured deposits. If you are dealing with an organization that is not insured by the State Insurance Corporation, you are taking a significant risk. When a bank goes bankrupt, the government, insurer, institution usually takes over. They may sell the bank to another, stronger, bank, or they may run the bank for a time as a state-owned bank. If you have uninsured deposits with an insured institution, you may run into trouble. Insured deposits are usually paid immediately after the bank goes bankrupt, but uninsured deposits may not be able to collect for years. A deposit insurance institution has to sell the bank and its assets and find out how much money is left, if any, for distribution to the creditors. What then? After bankruptcy has been declared, there is little reason to run into the bank or withdraw your deposits if your assets are insured. If the Deposit Insurance Corporation has already taken over the bank, then this weak and troubled bank will no longer hold your money, and either its ownership will be transferred to another strong bank or the corporation will manage it itself. Avoid banks at risk of bankruptcy. It's hard to know which banks will fail. You can check the website of the central bank or the authorized insurance institution in the country you are in to make sure that the bank you deal with is insured. Some bank rating organizations may help you avoid weak banks. These institutions follow the strength of banks and their business and expose them to various risks, and publish reports on that. In the end, and in order not to fall into the danger of an epidemic of bankruptcy, as medicine says, prevention is better than cure. Precaution is that before you deposit your money in the bank, you must know the position of the bank in the arena of banks, the system of work, money management and insurance, because bank insurance is insurance for your money.